Hello, everyone. Welcome to the weekly roundup. Today we will cover interest rates, inflation, and market sentiments. Hello, Ben.
Hi, Eva.
How's it going? How's the weather?
Summer. It's summer in Ottawa already.
I know, I know. This week has been intensely hot.
Yeah, it has. Yeah.
Okay, let's get right into it. Fed's Powell gave some forward guidance on interest rates this morning. I want to give us a quick recap.
Yeah, so I think that a lot of things going on. Obviously, lots of attention towards inflation and jobs, I think is where they've started to put a little bit more time and attention towards it. On the inflation front, I mean, for a couple of years now, people have been talking about the Fed potentially moving its band. They're kind of 0 to 2% is their inflation target. And so we seem to indicate that they'll go to 3% on their inflation target and give themselves a bit more room as, supply shocks and these kinds of fears that they have. So, they've changed their way they view inflation over the years. This one would be a pretty material change to look at, allowing them a bit more room in the inflation front. Um, the other piece, I guess, is jobs. So, jobs continues to be something to watch, and the job market's been a little bit more resilient, I think, which has helped them stay away from cutting rates. However, still, our view still is that they cut. Our economics team, I know, is going to do an update here at some point soon around what and more details around what the future path looks like. But we still anticipate rate cuts this year.
Okay. Speaking on inflation, numbers came out recently, and it seemed a bit better than expected. Will this also impact their decisions, and will this trend be sustained?
Yeah, I think one of the things I've said maybe a couple months ago is that maybe it's not as inflationary as the world thinks, where everyone sat in the backdrop where this is going to be inflationary pressure. At least the inflation numbers, to your point, are showing that things are actually disinflationary to some extent. So I think the softer numbers give at least the U.S. central bank room to cut rates. In Canada, we still think rates come down, maybe not as aggressively, just depending on how things play out here, but certainly the softer inflation numbers will give Powell a bit more room. I mean, the market bouncing back and spreads kind of, tightening instead of widening don't put as much pressure on the credit market, which is something he also watches. It's not his mandate, but it's something he also watches from a health of the financial system. But from the pure inflation perspective, to your point, I think it gives them room to cut rates.
Okay. And
Yeah.
then speaking again on tariffs, the US and China teased in on a deal. Do we
Mhm.
have any further details?
So it's one of the things where it's quite difficult to get through the granularity of all the different changes that they're making. And so when they came out with, we're going to tariff you this, and they came back with, we're going to tariff, like I think China came back to, we're going to tariff 145%. And then back and forth, back and forth. I think if you sum of the parts, at least from what our economics team has done, is it looks like something like 15% tariffs on the China-US trade agreements, we'll say. So I'd say the only thing that it really did immediately was all these ships that have been sitting offshore started to move to their ports. And so if you look at Chinese exports to the US, it grinded to a halt over the past couple of months. And so I think that's why both parties probably came to some kind of point where they said, let's see if we can get something in place. And yeah, as Trump's done with all his deals, nothing's permanent. So everything was a 90 days grace. But what you saw was all the ships starting to move to the US, and you started to see the shipping stocks rally big time out of it. And so I think some of the parts say 15% increased costs with tariffs both ways. All of it's not good for lower costs. Who's going to bear the brunt of it? Likely it'll be the consumer. But again, it's still a moving target. It's a little better than it was a week ago, but still not super clear on what it looks like from here.
Just a little bit of progress.
Yeah, yeah, exactly.
Yeah, let's be positive.
That's right. Exactly. We made progress.
Yeah. So we saw a few more earnings releases this week. How was the general market sentiment?
Yeah, so market sentiment continues to be positive and slash optimistic. And yeah, we spoke last week, which was a month the day, I think, when we saw the correction. And we've had positive sentiment all the way through. And so as I look at the sentiment indicators, a lot of people like to look at this fear and greed index. I do like it. It's interesting as well. And, we've tilted all the way back to where we're not quite in the extreme greed category, but we're really darn close. And so that would be a combination of looking at sentiment, looking at like put calls, options, looking at the volatility, looking at high yield spreads. That's kind of what makes up that index. And it's all gone back from, where we had extreme fear, tilting back towards the extreme greed on the lever. So sentiment's quite optimistic. My view has been probably makes sense if you spent some money and bought some things in April to take some profits, which we did a little bit of that this week, and so I think that makes a lot of sense at this point.
Yeah, let's go into the charts.
All right, you see all good?
Yeah.
Okay, perfect. Thanks. We are so recording May 15th, 1 o'clock, 1:30. Anything that happens after this, we certainly won't provide any guidance or comments on until next week. But lots of things to look at. I think this is a pretty important chart and something I think that is quite surprising for me how resilient the Canadian dollar has been given this backdrop. We had a investment chief investment officer of a firm out about 9 months ago to talk to us. And one of the things that they seemed to indicate at the time was we couldn't go further than maybe 1% max below where the Fed funds rate is, or the Canadian dollar go to 50 cents. And so interesting to see here, we are now materially lower than the US, so 1.75. Historically, this has been a time where the Canadian dollar has gotten quite weak, but it's been actually quite resilient this year. And so I think it's interesting to continue to look at this and pay attention to this. We do think that the Fed will cut rates, and that gives the Bank of Canada a bit more room to move in tandem. But at this point, this is as wide as we've been without any material pressure on the Canadian dollar. So that's been an interesting dynamic. There's lots of money that's been flowing into the Canadian bonds, Government of Canada bonds. So the International Monetary Fund has increased their weighting within Canadian bonds, and so part of that's helped the resiliency of it. But this has been a key call out that I think's worth paying attention to, given to the backdrop of the historics around Canadian US dollar. So, for those of you who've been following me for a long time, I often like to look at charts that have big divergences. And so, this is a commodities chart with gold and oil, with gold being the red one here, up around 3,300, and oil down around $60. And so, historically, it's been interesting to follow this. If we stretch this chart back further, when we get these material divergences, you start to think about what are the potential risk and or opportunities here. And so my view has started to shift a bit. We've had quite a good run in gold. And so I do think that my view has always been that you get that closure, those alligators close. And I do think that there's some relative thought to think about trimming some gold and potentially adding to some energy. So great chart, interesting divergence, and that's historically where there's been opportunities to think about how to prepare portfolios for what's ahead. So Eva, I know you asked me about this. So this is earnings. And so on the left-hand side, we have the TSX, 71% reported so far. On the right-hand side over here, we have the S&P 500, 90% reported so far. So I always like to look at this as well and say, did we beat? Did we miss? What happened? The U.S. has been more reported, so 76% beat. Interesting callouts always is to look at the where the negative divergences is. So what missed? So you had energy with pretty big miss, some utilities, consumer discretionary, consumer staples. And so that's relevant and certainly worth thinking about because some of the stocks got hit when they missed estimates. But that's typically been a reasonable reset point to think about adding to those names. So I'd be looking in probably those areas, those call out areas in the US. And then on the Canadian side, we have 71% reported. Communication services, 80% beat. So you may remember that communication services had a really bad year last year in 2024. And so now, as they've revised their numbers lower, now they're starting to get back on the side where they're beating estimates. So that would be BC, Rogers, TELUS. They all had good numbers. BC did a dividend cut, 56% dividend cut, which jumped ahead of what the market expected. So the stock liked that quite a lot. And then in the other areas here, similar to the US, where you have consumer discretionary that may be worth looking at. Healthcare is a small sector, so but that's a material miss as well. And consumer staples only 50% beat. So I think those are relevant and important to think about. A lot of good dividend paying stocks in there on the Canadian side that may be worth considering. But generally, the US earnings have been quite good. Canadian, a little bit less so, but still lots of opportunities as you come out of earnings season because some stocks can trade down quite materially when they miss estimates. So as always, the opinions expressed do not necessarily reflect those of National Bank Financial. Anything that is discussed today, if you have any questions, please consult myself or your investment advisor and make sure it's suitable for you. So that's it on the charts of the day today.
Quick charts.
Quick charts today.
Okay, so what are we looking at for next week?
So I think that one of the things I'm watching quite closely is just the volatility, see if that continues to come down. Bond yields have been something we haven't talked about for a little while here, a few weeks anyways. And so bond yields have been pretty resilient. Volatility has been coming down. The stock market itself has been starting to kind of face a little bit of overhead pressure too, because it's had a big rally off of the bottom. I mean, the S&P is up about 20% off of the bottom. And it's so it'll be interesting to see, can we continue or do we start to slow down from here? Broken through a lot of the technical levels that the technicians look at. So, starting to move up from below, which is positive sentiment gauge. But one of the things that we're seeing today, at least, and I'll be watching tomorrow, and then of course next week, is the volumes are starting to get a bit lighter. And so as the buying pressure continues to lighten up a little bit, I'd be looking to see if there's any follow through there.
Okay.
And in Canada, Monday is a holiday, so market will be closed as well. So a little bit of a shortened week there.
Okay, great. Thank you, Ben. Thank you, everyone. Please visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. And the link to our daily financial heartbeat will be in the caption of the video, as always. For clients, please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. Thank you, everyone, for listening, and have a great weekend. Bye.
Thanks, everybody.